Debt markets, how bonds work. John's keyboard business is now a massive success, but he has reached a ceiling. To fulfill the global demand for his custom Stickman Pro mechanical keyboards, he needs a full-scale factory. The price tag? $1 million. John doesn't want to sell a piece of his company yet, and his local bank isn't ready to lend that much to a single shop. So, John decides to enter the world of big league finance, the debt markets. He's going to issue bonds. As Brealey, Myers, and Marcus explain, a bond is essentially a formal IOU issued by a borrower to a group of lenders. Instead of borrowing from one bank, John is borrowing small amounts from hundreds of different investors. When John issues a bond, he is making a legal promise to do two things: pay a fixed amount of interest at regular intervals and repay the original amount he borrowed at a specific date in the future. The first thing John decides is the par value, also known as the face value. This is the amount he will pay back to each investor when the loan ends. Usually, in the corporate world, this is set at $1,000 per bond. If John needs $1 million, he will issue 1,000 of these bonds. Next, John has to decide on the coupon rate. This isn't a discount voucher for a shop. In finance, a coupon is the annual interest payment. If John sets a 7% coupon rate on a $1,000 bond, he is promising to pay the bondholder $70 every year. These payments are the rent John pays for using the investor's money. For many investors, these steady, predictable payments are the main reason they buy bonds. It's a reliable stream of income. The final piece of the puzzle is the maturity. This is the expiration date of the bond. John decides on a 10-year maturity. This means for the next decade, John will pay his investors their $70 coupons every year, and at the very end of year 10, he will hand back the full $1,000 face value to each bondholder. However, John quickly realizes that the bond market is a living, breathing thing. Once he issues these bonds, his investors don't have to hold on to them for 10 years. They can sell them to other people in the secondary market. This is where things get interesting for John. He notices that the price of his bonds starts to wiggle. Even though the face value is $1,000, some people are buying his bonds for $1,050, while others are only offering $950. Why would the price change if the promise of $70 a year stays the same? John remembers his lesson on the time value of money. The value of his bond depends on what other opportunities are out there. If the general interest rates in the economy rise to 9%, John's 7% bond looks like a bad deal. No one will want to pay the full $1,000 for it because they can get a better return elsewhere. To sell the bond, the price must drop. Conversely, if interest rates in the economy crash to 3%, John's 7% Stickman bond becomes a golden ticket. Everyone wants it, and the price will soar above $1,000. John learns that in the debt market, there is an inverse relationship between interest rates and bond prices. When rates go up, bond prices go down. When rates go down, bond prices go up. This is a fundamental law of the financial universe. By issuing bonds, John is transformed from a local craftsman into a debtor on a global stage. He has the capital he needs to build his factory, but he also has a heavy responsibility. Unlike dividends for stocks, bond coupons are a legal obligation. If John misses a single payment, his bondholders can take him to court or even force his business into bankruptcy. John looks at his new factory blueprints. He feels the weight of the $1 million promise he just made. But he also feels the power of the debt market. He has successfully skipped the middleman of the bank and went straight to the people. He is no longer just building keyboards. He is managing a sophisticated capital structure, using the tools of the bond market to fuel his dream.